Assalamu alaikum and welcome. So I'm your trainer Daniel Ali and today we're gonna start our course. It's financial planning analysis certification. So first of all, let me tell about myself. So I hold various professional qualifications and I have a 360 exposure of financial consultancy. I have an experience in FP&A. I have an experience in financial modeling, projections, IT audit consultancy, etc. I hold part qualification certification of chartered accountant along with a ACCA finalist. I am a CMA USA Certified Management Accountant Part 2 candidate. So I hold a membership of Institute of Financial Accountant UK and Institute of Public Accountant Australia. So I hold various certifications in data driving decisions making. Some of the prominent have been mentioned here. I'm a LinkedIn certified financial analyst, and most importantly, I have provided various trainings of financial modeling and financial management analytics to the CA firms here in Lahore. So I have a multiple exposure, and now let's begin to our task. So for the time being, we're gonna start studying or start understanding the financial planning analysis components. What are the components of FP&A and how they have a greater impact on the businesses of the organizations, a business, or you can say a large FMCG group or organization have a large range of activities and the elements. So how those are projected, how those are budgeted, how those are analyzed, we will be studying today in this topic. This involves the creating of detailed financial plan for the future. So what future? It is called forecasting. All of the financial planning moves around the forecasting financial statements or the management reports. Budgets are the part of financial statements as well as the parts of management reports. So what does budget do? It says budgets are used to plan and control spending, ensuring that resources are allocated effectively and efficiently. Budget is not 100% estimation of cost. For example, when a company do a target costing or do a forecasting, they got some differences. That's why, as a financial modeler, we prepare actual versus forecasted. As I show you, so in the front of your screen, you got a financial model of ABC company. So this is called alpha beta company. It's an hypothetical company. So as the front, you see I got assumption. At a below we have income statement. This is comparison of historical statement along with the projected statements. So see, I got projected result starting from financial year 2015 to financial year 2019. These are the historical amounts. Then I projected it to the 2020 and moving forward to the 2024. This, as you can see, this is not a 100% accurate result due to some market conditions, prevailing costs, the up and down, you can say inflation cost, other things, there's a lot of difference. You can say, for example, financial year 2020, we have a revenue of 552,798. So it is projected, or we can say it is budgeted. But in a real sense, we can get a actual result which is different from the projected. This is only the estimation. This is used for getting the loan from the banks. This is used for the auditing purpose, for the projecting auditing, internal audit projections. We use the financial models. And similarly, these are the costs. These are not 100% accurate results. So forecasting are just best estimates by financial modelers to get 100% insights of what the company is performing. Any question till now? You can open your mic and ask the question. So the next point, it says forecasting. Financial planning analysis requires forecasting future financial outcomes based on current and historical data. As I show you the financial model, it includes the historical data as well as the projected data, the forecasted data. It says this includes sales forecasted. We have seen it says cash flow forecasted. So here is the cash flow forecasted, income statement, balance sheet, and the cash flow statement, starting from her historical result, ending at the projected result. It includes all operating cash flows, investing cash flow, financing cash flows, and the net increase or decrease in the cash balance. As we remember, in our studies, we make a ledger of that cash. So this is a cash ledger in the statement form. It separately includes the capex cost. It separately includes the outflows of the cash and some expenses. Then we have sporting schedules. These are also required for auditing purpose, for the projection purpose. And these are all the important components of financial planning and analysis as well as the financial modeling. So see, it says include sale forecasted, we have seen it. It says cash flow forecasted, we have seen it. It says other financial projection, we have seen it. Using the schedules, as I have shown, performance analysis. This involves analyzing financial performance of the business. It includes comparing actual results to the budgeted figures. So yes, actual versus budgeted, actual versus forecasted comes under performance. So any question till the sheet 1 or I'll move to sheet 2. If you have any question, you can ask me. So for the next thing, it says scenario and sensitivity analysis. This is very, you can say, important part of financial management as well as financial planning analysis. It says scenario and sensitivity analysis. What it is, financial planning analysis professions often prepare scenarios to understand potential impact of various business decisions or external factors. I'll show you. So see here, at the top, I have assumption. It says worst scenario. It have been chosen from here. The next sheet, scenarios. I have current scenario which is shown here in the front of us in the model. The next thing, I have the next scenario of assumptions, normal scenario. In the normal, you can see financial year 2020, my revenue growth is 10.50%. Whereas current scenario, it had chosen the 2020. Why 20%? Why? Because I have given the case of 20. The third thing, you can see the worst scenario. Revenue growth. Revenue is growing 20%, but in a negative, minus 20. See here, it's minus 20 result. You can see here, which is linked with the assumption available in the separate sheet. This is the best practices of financial modeling. You can see here. We will learn this when our financial modeling starts in next 2 or 3 sessions. We will be starting financial modeling. I will be training you. You will be learning all of this practically, and you will get the recording side by side. All the files will be available, and you will learn, and you will be very much excited in preparing the financial model. At the top, you can see the freelancers, the web developers, along with the financial analysts, are the number one earning the highest ones. So this is scenario analysis. What is sensitivity analysis? It is the similar. It is used for checking the end result. For example, if I increase or decrease my revenue growth, what would be the expense for our, you can say, just wait for a second. I'll move this top. Yes, in the model. So what does sensitivity analysis do? If I change my growth, what will it output on our net earning? That is sensitivity analysis. So as I show you that it says sensitivity analysis and the scenario analysis financial planning analysis professionals use to prepare scenarios to understand potential impact of various business decisions or the external factor. So here what it is telling about the external factor, the inflation, the prices, the selling. If we import goods from other countries, then it is an external factor. The foreign currency exchange factor here is the most important thing if we import goods. If we export goods, then it is also an important key component of the sensitivity analysis as well as the costing, the selling point of view. This includes the best case, worst case, and most likely scenarios. As you are financial modelers, you can prepare multiple scenarios, but the best practices suggest that there should be three cases only: best, worst, or you can say the normal case. Whatever name you suggest, that would be easy for you to understand. And one more thing, as a financial modeler, you have the complete knowledge of historical data as well as the financial data, which you can explain to the end user. The end user is not a financial analyst. He only wants to see the growth or the decrease. He will ask the reason. He will not move in deep insights to get a result. So, what is strategic planning? It says financial planning is closely linked with strategic planning. It involves aligning financial goals, budgets with the company, long term strategic objectives. So, just wait. All right. So, strategic planning we use for long-term goals. As you see, we I have prepared 5-year projections. If we have requirement of 10-year projection, we can prepare a 10-year projection. If we are preparing monthly rolling, we can do a monthly rolling forecast for 2 years, 3 years, 4 years. It's up to our requirement. That which requirement do we want? What is our ultimate goal to show? The next thing it says involves aligning financial goals and budgets with the company's long term strategic objectives. Yes, the objectives are aligned with the budgets with actual versus forecasted results. So, for as our financial planning increases, as our feasibility reports increases, our planning increases, our goals also changes, our budgets also changes, and we can make more projections. Cash flow management. Yes, the financial planning analysis also helps for the cash flow management. Managing the inflow and outflow of the cash is crucial for maintaining the liquidity and financial health of the organization. Yes, I'll show you the income statement, balance sheet, and the cash flow. See, I have, let me zoom it. Yes, I have operating cash flow starting from net earning. Where it is linked to the income statement. I have income statement items, net income, depreciation, working capital changes come from balance sheet. I have investing cash flows, which shows investment in property, plant, equipment, which is also linked to balance sheet. See here, all my financial model is linked with the supporting schedules. You will be looking it side by side. Why I am showing you cash flow statement? As it states that this help for the strategic planning and for the cash flow management. We can see this cash flow statement, projected cash flow, is very important for auditing purpose as well. You know, as a finance profession, the basic requirement of auditor is to see that cash flow is aligned or not, the closing cash balance aligned with the opening cash balance or not, how this increase or decrease in cash have been aligned, and how it have been come to a certain amount. This statement is very important. The next thing, financial model. Creating detailed financial model is a key part of financial planning analysis. This model are used for budgeting, forecasting, decision making. Yes, as we had discussed earlier, this model complete three statement model. So here you can see the graph. Certainly it is not working. Here you can see net earning projection versus inflation. You can see the result, financial year result, as well as the amounts, the growth, the bars difference. You see, you take the decisions and make it important. This is the strategic part of the decision making. The next thing, variance analysis. This involves analyzing difference between planned and actual financial outcomes, understanding the reasons behind these variances, taking the corrective actions if necessary. Yes, the thing we have talked earlier, that it's actual versus forecast, actual versus budgeted, plan versus budgeted, plan and budgeted versus actual, the variance, the difference, negative result or positive result, that is also very important for the financial planning analysis analyst to see why these differences have become and what are the costs. See, if cost increases, why cost increases? We have to see why cost increases, what are the factors, whether it's internal or external, whether it's our factory cost increase or our import cost increase. We have to see it and we have to do it minimum by using the projections. Capital planning and investment analysis. So as name suggests, that capital planning, so first thing comes into mind is the initial investment which the shareholders, or you can say the stakeholder, invest for starting an organization. So capital planning is very important to start an organization. Investment is also a part, as a multinational have been listed in SECP, Security Exchange Commission Pakistan. So it, when it registers, they allow them to float their shares in the market to get the capital. We as an end user, we got those shares at a certain price that we do investment. So as a financial analyst, we do investment analysis as well. Risk management. So there is a risk in every company. So there is a risk in every cost. It says that risk management, identifying and managing financial risk, is an integral part of financial planning analysis. Yes, where there is a risk, where there is a, you can say where there is a finance, there is a risk. Financial planning analysis analyst helps to mitigate, helps to lower the risk, but risk cannot be zero. Data analytics and reporting. Yes, financial planning analysis professionals work extensively with the data, analyzing financial information and preparing reports for the management and the stakeholder. Yes, data analysis. As the name refers, that we have to analyze data deeply. So there are multiple tools of analyzing data. We have Tableau, we have Excel, we have Microsoft Power BI, we have QuickSense. As you can see, many bookkeeping solutions have data analysis tab for the analyzing and the reporting. So what is reporting? We pass a journal entry in CRM and CRM software. The journal entry moves to the ledger, etc. At the end, we got the balance sheet, income statement. That is reporting. One thing. What after reporting? We need decisions for the future. That decisions come from the data analysis. We do data analysis in data analysis specialist softwares or using the BI, business intelligence software. A good thing in this course is that we're going to learn data analysis using Microsoft Power BI business intelligence tool, and that would be start from the zero. I will be taking from scratch how tool works, starting and ending at how we can prepare the financial reports on Power BI, how we can take the decisions, how different formulas. We will be also working on sensitivity analysis, scenario analysis there on BI tool as well. The stakeholder communication. As financial planning analyst works, it prepare different reports, and then those reports have to be communicated to someone. So those people who reports have been provided, those are called stakeholders. Communicating financial plan, forecasted performance to stockholders, including management, investor, employees, is an important aspect of financial planning analysis. Any question for the topic one? You can ask, you can open your mic. Understanding structure of financial statement. Just wait for 2 seconds. I need to charge. So yes, the next topic we're gonna start. It's understanding the structure of financial statement. So yes, this is very important topic as some of the candidates are CMA certified, some of the candidates are the part of CMA USA. They have an important topic of understanding the structure of financial statements in the part 2 exam of the CMA USA, and that is an MCQ based exam. This will be very helpful for them as well. So it says understanding the structure of financial statements. The structure of financial statements is fundamental to understanding company's financial health and the performance. Generally, a company sets financial statement includes the following components. So yes, everyone here knows what are the components as I show you here. Let me move to the top. Let me zoom out. So yes, here is the cash flow management. Yes, income statement, balance sheet, and the cash flow. We have all three statements available here. So this is the projected financial statement. Let us see further the balance sheet. First thing is called the balance sheet statement of financial position. It shows the position where the company stands. So first of all, we have the assets. As you know, assets are long term as well as the short term assets. So remember, in projecting financial modeling, in the financial modeling, we have some certain key assumptions. The best practices, you can say that our assets have been starting from the current assets, ending at the non-current assets. So this is little bit variation from the International Financial Reporting Statement, the standard IS1. It is little bit different, but it's in choice. You as a financial modeler, you have a choice whether you can follow the best practices or you can follow the industry best practices IS1 requirement, starting from non-current asset moving towards the current assets. Next thing, it says balance sheet include assets. These are the resources owned or controlled by the business. Yes, the business starts as a capital investment. These are the assets. It's also called the capex. These are typically divided into current assets. These are the assets expected to be converted into cash within a year. They're readily available, such as account receivables, inventory. Non-current assets, we have long-term assets not expected to be converted into cash within a year. Yes, these are not readily available into a cash form, such as PPE, intangible assets, or right of use assets. Liabilities, obligations the company owes to external parties. Yes, see here, I have liability, debt, I have liability, account payable, I have to pay it. So here you see financing cash flow, I have to pay debt, I have to get equity. So this is capital planning part. I have to repay debt. It's in negative form. So yes, this is the repayment of debt includes the part of financing cash flows. Here is the supporting schedules. So see, I have debt and interest schedule. We have opening debt. We have the issuance or repayments. Then we have closing debt. and we have interest available. So there are the debts we can see using IFRS 9 or IFRS 16. Liabilities. Current liabilities of same as current assets we have to pay within a 1 year, such as our account payables or other some short-term debts or any part of long-term debt within a year to be paid. Non-current liabilities, we have the obligations which we have to pay after the 1 year. So it's a long-term debt, the pension payment, etc. The third thing is equity, also known as shareholders' equity. It represents the residual interest in the assets of the entity after deducting liability. So this is the definition which is not available in IS1, the IFRS guide. This is the definition available in the US GAAP, generally accepted accounting principles. The US has a different accounting principles while IFRS have some different accounting principles. There's a difference between both principles, and yes, now the Middle East have been adopting US gaps and it have been shifting from IFRS. Components include common stock. Yes, we have a stock, we have a preferred share, we have retained earnings, and the treasury stocks. So there is a separate statement of changes in equity which is also prepared. That changes in equity end result comes here under the equity part of the balance sheet. So see here, I have shareholder equity, equity capital, the retained earning, and the total shareholder equity result. The next thing, it says cash flow statement, this income statement. Yes, it's a statement of profit and loss. Our income statement starting from the revenues, ending at the net income. Every organization has a different format of calculating the net revenue. There's a different formats available. Some of them as the manufacturing companies, so they have to show the manufacturing account as well, the prime cost, the other cost, direct labor as well. All of those things comes into the cost of goods sold. The revenues are projected along in the different location. Operating segments, our IFRS 8 suggests that the operating segments values operating expenses include many costs of the expenses, sales and the marketing, etc. Operating income, gross profit minus operating. Yes, in US GAAP we call it operating income. In IFRS we call it EBITDA. Just enable editing. Yes, in IFRS we call EBITDA. It's earning before interest, tax, depreciation, and amortization. As we knew, amortization has been charged on intangible assets, depreciation charged on tangible assets, tax is charged at, you can say, the taxable rates of the company, types of organizations available in the Pakistan, single member, small SME organization, large organization. So there's a different tax rate. So interest, it's the financing cost we have seen in the income statement, in the cash flow statement as well. The supporting schedule of debt and interest. Here is the interest calculation. So yes, EBITDA comes in IFRS. EBITDA doesn't comes under US GAAP. There is a difference. Net income, the final profit or loss after subtracting all expenses, including the tax interest from the total revenue, we got a residual amount called net income. So there are the different names of the net income. Some call PAT, after profit after tax. Some call it profit after tax, after interest payment, deduction of depreciation, etc. There are multiple names. In US GAAP, there are a lot of multiple names available of the some single item. By generally, US GAAP is very easy than IFRS. I'll show you. So I have less than 1 minute available. So I'll be generating a new link and sharing in the group as well. So we were back at the income statement understanding. So income statement says statement of profit and loss. As I told before, we start from the revenue ending at the net income. So the US caps doesn't explain the operating income. It says operating income while it doesn't explain EBITDA. Whereas the IFRS, as I have written here, it suggests EBITDA and the EBIT and then the net income. It breaks the operating income in multiple items to get better understanding, while the you can say US cap doesn't breaks it. User US cap start from the revenue or the sales, ends at the net income or the net profit, and show you a single statement. Doesn't explain a lot. So there are some differences. The next thing, we were starting the cash flow statements. As the cash flow activity start from the cash flow activities, it says cash flows from the primary revenue generating activities of the business. So what are the primary revenue generating activities? So these are the operating segments. So just it suggests operating segments of the business. The IFRS 8 applies here. So what is the different expenses, the different, you can say the selling expenses, general expenses. So all of the day-to-day operations are the operating activities. Now I shall show you here in a practical cash flow statement. Let me move up. So yes, here is the cash flow statement starting from the net earnings. So it has been linked to the income statement and down moving towards the balance sheet items. Net earnings, depreciation and amortization, and the less working capital. So you know the working capital appears from the balance sheet. We have the working capital schedule as well added below. So yes, so these are the day-to-day operations which have to be shown under the cash flow statement. The next thing, I have investing activities says cash flow related to the acquisition and disposal of the long-term assets and the other investment. So the most commonly example is we purchase capex, capital expenditure. We purchase, you can say investment, IS 40 investment property comes under the investing activities heading. So if we dispose of any asset, if we dispose of any investment, it comes under investing activity. We have to see the actual cash movement within the years or within the month of the organization, and for this we have to take the cash flow management decision as the financial planning analysis analysts perform, and that's the main thing, or you can say the backbone of the organization, the cash flow management. The next thing is financing activities. It says that cash flow related to the transactions with the shareholders, creditors such as issuing stock, paying dividends, borrowing money comes under financing activities. So yes, we pay dividend comes under financing activities. So there is a clash between IS 7, or you can say the US GAAP, the cash flow statement. Somewhere they suggest that we have to pay dividend under the operating activities. We have to show paying dividend under the operating activities. Some of the studies suggest that it should come under the financing activities. There is a big MOT, but there is no restriction. We can show how where we are paying the dividends under different headings, operating activities as well as the financing activities. As IFRS suggests, we have to show under the financing activities, but US GAAP. So there is a difference. US GAAP shows that it should become under the operating activities. Net increase or decrease in cash. The last thing, it says the sum of the cash flows from operating, investing, and the financing activities is called net increase or decrease. This shows whether the cash is moving up, whether the organization is holding the cash, or whether the organization has spent a lot of cash during the year, during the projected period. So why I'm telling projected period side by side? Because we have to show the projected financial statements to the shareholder for the decisions, for the management decisions, to the board of directors to take a long-term decisions. The decrease in cash will not take them into the confidence. They will think that management is taking wrong decisions. The organization is spending a lot of cash. Where does the cash goes? That cash can be seen under the cash flow statement heading, under the operating activities, under the investing activities, under the financing activities. We have to see, we have to analyze that very easily. We have to analyze that deeply to get the result. The next thing, we have statement of changes in equity. The statement shows changes in a company's equity during this specific period. It includes profit or losses. It includes dividend payments and the effects of accounting policies. So IS 8 effect comes under changes in equity, change in accounting policies. We show the dividend payments from our shares, from our bonus shares, etc. We show the retained earning, which includes the last year profits and the current year profits under changes in equity. Let me show you. So here I have a shareholder equity heading of historical data moving towards the projected data. It states equity capital, retained earnings, shareholder equity. Yes, this is the equity statement, changes in equity statement. You can prepare it in a separate sheet or you can prepare in a separate way. Under you can see here I have a heading of sporting schedule. Yes, we have sporting schedule. We can prepare his equity schedule. See here, I have equity schedule, opening equity. I have the issuance or the repayment heading. I have the closing equity balance. This closing equity balance move up towards, you can see here, to the shareholder equity ending balance. So yes, it is linked at the below to the working schedule. All of this is the equity statement. We'll be looking a deep enhanced equity statement as well. Just wait. I'll show you another great thing. So yes, here is equity valuation statement. So we have income statement in front of us, starting from the revenue, ending at the profit. It's a, you can say, a summarized income statement. But next thing, the great thing, we have a capital employed heading. So it starts from year 2020, ending at the 2023, and we have a working capital. It states current assets and the current liability. There is a residual amount called the working capital. So yes, I have a working capital, I have a fixed asset schedule here, and then the fixed asset schedule plus my working capital, I got my capital employed, I have my long-term debt, and then I got my equity. This all statement will be also explained to you how we can prepare it to get the market value of equity. Price to book ratio, this is the estimation. This comes under the equity valuation. This will be learning under the heading of, you can say, the corporate finance or the business finance decisions. We'll be understanding price to book ratio, what is price to book ratio, how it is meant for the financial modelers, how we can get the market value of equity. So yes, this statement is all around linking towards and projecting or to estimating our market value of equity. I got market value of equity for the 2020 ending at the 2023, starting from the income statement. So all of these projections, or you can say historical calculation, I'll be training you on this. So for the next topic, yes, it's our third topic, relationship between the three statement model. We have covered the two topics. So now you can open your mic or you can tell in the chat box if my speed is fast or whether it's good and how's the session. And now we will be moving towards the third topic, relationship between three statement models.
आई थिंक सो फार आपने सारी चीज़ों को कवर कर दिया है जो जो हमें रिक्वायर्ड है फाइनेंशियल मॉडलिंग के लिए। के सारी अगर हम फाइनेंस से हैं या कोई भी लोग इस तरह के जो जिन्होंने बीबी है, एमबी किया हुआ है, फाइनेंस और बेसिक फाइनेंशियल जो एजुकेशन है वो तो उनकी होती है। तो वी आर गोइंग वेल। मेरा नहीं ख्याल कि यहाँ पे रुकने की जरूरत है। मेरे ख्याल से बाकी कोई पार्टिसिपेंट अपना ऐड करना चाहे।
Okay, let me move forward. Yes, relationship between three shipping model. As you see the example, and I have shown an Excel workbook side by side that says the three statement financial model comprising income statement, balance sheet, and the cash flow statement. It's the cornerstone of the financial analysis and the business valuation. These statements are intricately connected and provide comprehensive view of the financial health. Yes, so it's provide a financial health. We have to see it how the C7 model have been relationalized, and now we have to see how we link income statement to the balance sheet. So first thing is net income. The bottom line of the net income, it says net income or the profit after tax, etc., feeds into the balance sheet as a part of equity called retained earning. As we have explained earlier, this connection shows how a company earnings affects its overall financial position. Depreciation, amortization, these non-cash expenses from the income statement reduces the value of assets. Yes, as you see, depreciation reduces the value of assets or the amortization reduces the value of the assets. Yes, these are the non-cash items. That's why we add back in the cash flow statement, and from where we get the depreciation, we get the depreciation from the value of asset. There are different methods of calculating depreciation on the balance sheet items as well. Next thing, we have the balance sheet to the cash flow statement. So yes, our working capital changes. It says variation in the current assets like inventory, account receivables, and the current liabilities like account payables on the balance sheet are reflected to the cash flow from the operating. I have shown you earlier. Now I again show you. So yes, we have the balance sheet, we have the cash flow statement, our net earnings comes from income statement, depreciation amortization comes from the balance sheet, working capital changes come from the balance sheet. Now we move forward. It says long-term asset purchases. Yes, if we purchase or sell long-term asset, it appears on the balance sheet and are reflected to the cash flow from the investing activities. We have seen before it that an equity transaction movement in debt or equity are shown on the balance sheet and the cash flow from the financing activity. Income statement to the cash flow statement, it says operating cash flows. The income statement net income is adjusted for the non-cash items like depreciation, like working capital changes, comes from the balance sheet as I stated before. It arrives as the cash flow from the operating activities. Interest and the dividend. Interest expense and the interest income as well as dividend paid are found in the income statement which affect cash flow from the financing activities. Let me show you. Yes, here is the cash flow financing activities. It says, it says issuance or repayments of debt available. It says issuance or repayment of equity comes under the heading financing cash flow. We have seen practically here. The next thing, it says closing loop, how balance how cash flow statement closes and approaches to the balance sheet. It says cash and cash equivalents, the closing balance of the cash and cash equivalents from the cash flow statement becomes the opening balance of the cash on the balance sheet for the next period. Yes, our cash and cash equivalents have been shown in the cash flow statement at the end of the cash flow statement, and that is linked to the balance sheet. Cumulative impact. What is cumulative impact of the cash flow? The sum of the cash flows from operating activities, investing, and the financing activities show changes in the cash position on the balance sheet. We have seen it. Interconnected dynamics, earnings and cash generation. It says a company's ability to generate earnings income statement and its ability to generate cash flow statement are different but interconnected aspects to the financial health. Yes, it says that earnings are different, cash is different. So how company changes, how company earns and make that earning into cash, we have to see that how cash is generated. So how income is generated and linked and it is converted readily available into cash. This shows the financial health of the organization, a complete process. Next thing, it says financial position and operations. The balance sheet provides a snapshot of the company's financial position at a point in at a point in time means a position where company stands. Where now it's a year end company stands in the year 2023 December. Some companies had different financial years. So at a certain time where a company stands, that is called financial position and its operations, where a company stands and how much it will perform, that have been shown in the income statement. As it states further, while income statement and the cash flow statement shows how operations affect this position over the period. Yes, it shows how company stands over the time and how well it performed. This being shown using income statement and cash flow, while our financial position or our balance sheet shows where company stands now along with the historical result, investing, financing and operations. The next thing, it says decisions around investments captured in the cash flow from investing activities and the financing activities reflected both in balance sheet and the cash flow activities impacts company's operation capabilities and the profitability. So it says company's capability. How capable, how much capable is a company to acquire something, that is known as a merger and acquisition part. The merger and acquisition in accounting, we do it consolidation. In finance, we call merger and acquisition. Does the company capable of merging? Does the company have a shareholder or the retained earning or the cash available to acquire another company? So all of these things we see from the cash flow and the balance sheet thing. It says the next thing, it's framework of financial reporting for financial planning analysis. Developing a framework, I'll tell you. So there is a framework guided by IFRS, it is IS1. The next thing, we have IS1 available, which tells us guidance how we can prepare financial reports, financial statements. US GAAP has a separate framework, have a separate guidelines how we can prepare financial reports. While each country has a separate guidance how they prepare financial reports, which are interlinked with the international financial reporting framework. As in Pakistan, we have Companies Act 2018. It tells how 2017 how well an organization can prepare financial statements using IFRS IS1 standard. It says developing a framework for financial reporting and financial planning analysis involves structuring a system that provides accurate, timely, and relevant financial information to the stakeholders. So, yes, here it is telling about IS1, how IS1 helps FP&A to get a structured financial statement. So, here's a framework. It says first, we have to establish reporting objectives, alignment with the strategic goals. Ensure financial reporting aligns with the organization strategic objectives. Yes, what are the objectives of the organization? How those objectives have to be met? The different questions, the W's, what, why, when, all of these have to be interconnected to get a strategic goal and to see how we can see that the financial reporting works for the financial analysis. All of this have been decided using the board of director meetings, the financial reporting meetings, manager level meeting, the senior level meeting. Next thing it says compliance and standard adherence. Reporting should comply with the applicable financial reporting standard. So yes, here it is talking about IS1 and a US GAAP decision making score focus on providing information that supports strategic and operational decision making. So yes, it says a framework should be focused on how well an information can be gathered, can be shown to the different levels of organization, the different levels of hierarchy, strategic level, this means the top level, operational level, this means the lower level. But the reporting framework should be same and should be understandable to all of the finance professionals. Define key performance indicators. Financial KPIs include matrices such as revenue growth, profit margins, EBITDA, ROI, and the cash flow. So yes, each financial analyst have a different list of KPIs. Each organization can show multiple KPIs. There are different KPIs which they can show important relevant information. The most important are being discussed here. It says revenue growth, the profit margins, EBITDA, ROI, and the cash flows. The next thing it says operational KPIs. It says depending on the business, these might include customer acquisition cost, inventory turnover, or the productivity metrics. So yes, there are some financial KPIs, there are some non-financial KPIs. Both are important for the organization. Yes, both are important for the organization. Both are important for the decision making. Some of the, you can say, KPIs which doesn't show numeric results but are very important. Those are non-financial KPIs. Some KPIs which are very important for the stakeholder decision, for the BOD decisions, that are the financial KPIs such as revenue growth, profit margin, EBITDA, ROI, and the cash flow, etc. Custom KPIs. Yes, as a financial analyst, you have a complete information, you have a complete deep information of the organization as well as the industry. Yes, you get different goals and you see the different approaches how we can approach that goal. Yes, you have the industry average result as well. You can create some custom KPIs which are very important to you. The next thing it says financial reporting components. It says income statement analysis, regular reports on revenue, expense, profitability trends over time. So there are multiple income statement analysis things we will be looking that as well. The balance sheet review, analysis of assets, liabilities, equity, research, company financial position. We can see the vertical analysis of balance sheet, the horizontal analysis of balance sheet, the vertical analysis of income statement, a beta analysis of income statement. We will be looking all those how we can prepare it. Cash flow statement, same tracking cash inflows and outflows, its impact on financial health, budgets, and actual performance measurements. Regular comparison of budgeted figures against actual performance. Reporting frequency and time. Yes, how much how many times do we report our, you can say, financial reports to the BOD, to the operation level, to the management level, to the strategic level. It says monthly reports, quarterly reports, annually reports. Monthly report for internal management and the performance tracking, quarterly reports for the broader stakeholder communication including the board members and the investors. Yes, so quarterly reports are available for the BOD as we can see on different websites. Quarterly reports, the annually reports are available, but monthly reports are not available. These monthly reports are only available to the management, to the performance tracking for the management. These are used for internal audit processes. Yes, next thing we have data source integrity, how we can collect the data. So it has been suggested that there is an automated data collection system, the CRM system, the bookkeeping systems such as QuickBooks, Zoo, SAP. There are multiple modules of SAP, Microsoft Dynamics. There are multiple ERP systems, the custom built ERP system, here map-based ERP system. It says where possible, automated data collection from the various system, example ERP, CRM, data verification. Establish procedures to ensure data accuracy and reliability. It says that data should be accurate, data should be reliable, and then data should be in automated data collection form to get an integrated report. Those reports should be in monthly format, should be in quarterly report, should be in the annually report to see the result. Annually is some comprehensive overview of the financial reports. We can do many analysis on that. Stakeholder communication are the same. The report should be communicated to the stakeholders, customization for the audiences, tailored reports for the different audiences, management, investor, regulatory bodies, clear and concise presentation. Yes, the report should be concise, the report should be clear, the report should be understandable for the end users. The next thing it says compliance and continuous improve. Yes, the report should be compliant with the IFRS, with the US cap, and with the Companies Act. Whatever the act the respective company or the country follow, it should be compliant that act. Adaptability, be prepared to adapt the framework in response to the change in the business environment or the strategy. Yes, this is very important that the report should be user friendly, should be easily changeable after environment business changes or there is anything available. If there is a social integrity available, the report should be changed very easily. Training and development, staff training. Ensure that the team is well trained in the financial reporting principles and the tools. Yes, the staff training is very important to enhance their skills, to enhance their professional behavior, their analytical thinking, their professional communication. Staff training is very important. It should be well ensured system. A continuous learning, stay updated with the best practices and technological advancement in the financial reporting. Yes, this is very important that the finance professionals should be updated with the best practices, should be you can say familiar with the advanced technological advancements in the financial reporting. They should be aware of AI tools, they should be aware of you can say the CRM system, the bookkeeping systems. So as there are trend changes, there is a lot of difference. The last topic to discuss today is management decision analysis framework for FP&A. This is similar to the framework available of the financial reporting from F&P, but there are some differences. So we have to see those differences, why management and decision analysis framework is important for FP&A. We have to see it. It says management decision analysis is a structured approach combining data collection, analytical techniques, and the decision making tools to make informed business decisions. Yes, it's a complete process starting from as in computer technology. We will be looking that side by side as well. It says we have input, then we process that input using different techniques. We got the output of our desired result. So yes, here it says we combine data that comes under input. We collect data comes under input, then we process it. We have analytical techniques available, we have machine learning techniques available, we have artificial intelligence techniques available, we have business intelligence techniques available, we have financial analysis techniques available. So yes, those techniques are available for making decisions. After applying those techniques, we got an output result. That output result is used for the decision making. That output result is called financial reports, is called management reports. We can say internal reports. Those are used for the decision making, and then the C-level executives, the BOD, the stakeholders make decisions for the further business activities, for the further business enhancement. It says it involves gathering and managing data using both quantitative and the qualitative analysis, applying decision supporting systems, as I have discussed before. MD&A emphasizes critical evaluation of potential outcomes, aligning decisions with the strategic goals, assessing feasibility, ROI, return on investment. Return on investment is very important. As all of the participants have invested in this course, they should get a better result, better return. I hope at the end of the course they get a better result, better return on their investment. It includes implementing decisions, monitoring their outcomes, and communicating findings stakeholders. Yes, the decisions should be very, you can say, easy, understandable for the stakeholders when they are communicated by the management. Continuous improvement and staying updated with the new method tools are likely aspect of MD&A. Yes, this is a very, you can say, essential thing for the management, making it vital for effective strategic decision making in the business. Yes, this is very important. The next thing, we have some key guidance. I will be start. So yes, the time is left 2 minutes. I'll be sharing the new link within the 5 minutes. Thank you. This will be automatic closing. So for this, I'll be stop sharing my link. So yes, as management decision analysis framework structured, it says the first thing is we have to define the objectives and the scope of the process which we gonna make. It says determine the primary goal of P&A framework. This could include improve accuracy in the financial forecasting, enhance budgeting process, or effective allocation of resources. As same. So yes, we have to establish the framework, we according to different departments, according to functions and the business units it covers. So it is a framework means a guidance, a complete guidance how we can prepare things, how we can allocate the cost, a guidance how we can do budget, how we can do forecasting. So a guidance is very essential need for financial modeler, for financial analyst, for FP&A analyst. And yes, there are some multiple different things as similar. It says gather and analyze data. Yes, we have to collect the resources. Now here it explains that what are the financial data should be calculated, should be collected. It says historical financial statements, it says budgeted reports, market trends, the inflation cost report, etc. All should be gathered and then it should be analyzed. It says implement analytical tools and techniques such as variances analysis. So this is a technique. Trend analysis, this is also a technique. Ratio analysis, this is a technique to evaluate financial performance. Let me show you a report here. So yes, here I have an income statement of the 5 years starting from 2020 to the 2024, and you can see a projected income statement. So I have an export sales, I have a domestic sales, I have a cost of good breakdown, I have a gross profit, operating expenses breakdown to the EBITDA, EBIT, EBT, and the net profit. The next, a very good thing, I have an EBITDA analysis here. See my EBITDA, I have assumed it is 100%. So as EBITDA is 100%, what is the percent of the revenue to the EBITDA? See, My export sales are 142.86%. So this is an advanced analysis of an income statement. This is a technique. EBITDA analysis, net profit analysis is a techniques of analysis, is a technique of finding the trends of the industry or the company in the market. We have, so these trend, these analysis should be shown to external stakeholders, external shareholders, or the internal management to get a better performance for the next time. The next sheet, I have a vertical analysis. So yes, as I have a vertical analysis, so yes, this can also tell us that how much different percent of the income statement items are of the sales, the cutting sales. So I have export sales, I have a domestic sales, my total revenue sales is 100%, another are the percentage of that. We will be preparing these as well. The next thing, developing financial models. It says create a financial model that reflects the business operations, including cash flow statement, budgeting models, and what if scenario analysis. Yes, what if scenario analysis is technique of BI, business intelligence. What if available in the business intelligence. This is also available in Excel in business intelligence tools such as a Power BI or Tableau or QuickSense. It is a very advanced version which is available in Excel such as data tables, the goal sheets, etc. Ensure these models are flexible and can be updated as the new data becomes available or the business circumstances change. Yes, we should make our models flexible, easy for understandable, user friendly so everyone can understand and can update. If inflation increases, it can be easily to update. If inflation decreases, it can easily be updated. If foreign currency changes our cost, it can be easily cutting the cost or it can easily improve the cost in our model. Integrate technology solution. This is a new thing. It's a utilize software tools and platform that facilitate financial planning analysis. This might include ERP systems, enterprise resource planning, budgeting software, data visualization tools. Ensure that technology is scalable and can integrate with the existing system within the organization. This means that the internal technology should be updated, should be marked up to date for the management report, for preparing financial report, for preparing different reports. Implement risk management strategies. A financial analyst should understand what are the risk management strategies, what are the risk management tools, how these risk management tools helpful for the financial analyst for making the decisions. Next thing, it says we should develop strategies to mitigate this risk. Yes, we should see how we can lower the risk. Risk cannot be zero. It shall be come to the minimum level, but would not be zero. The hedging techniques as are available in IFRS 9, how we can maintain the liquidity reserves. Training and communication with the stakeholder. Training the employees is very important. Training them for the new FP&A tools, for the financial forecasting, for the processes is very important. Communicate the benefit and usage of the framework to all stakeholders. It is very important. We should communicate the framework to the stakeholder first, then we should communicate the financial reports to the stakeholders along with the management reports for the decision making. At the last, we have monitor review. This comes under auditing process, the internal auditing process and the external auditing process. Regularly monitor the framework effectiveness in achieving its objective. Yes, it's the primary responsibility of management for regularly monitor whether the framework have been changed or we can update according to our requirement. So for example, if there's a change in environment, if there's a change in climate, we should know how we can update, how we can enhance our finance team along with working on FP&A with the financial planning analysis framework. The management should understand the availability, the adaptability, the understanding of the framework, and how well it can further be structured if there's in climate change, if there's an environment change, if there is an business operation change. Next thing it says review and update framework periodically to reflect change in business environment or strategic decisions of the organization. Yes, if we have understand what is framework, then we have understand how we can update the framework if there is any change in the business environment, if our long-term strategic goals are we are achieved, and we have further prepared some more long-term goals, how those long-term goals can be achieved using this old framework, or if it needs to amend it for the further working. So yes, we have completed our first session topics. If you have any questions, you can ask me. Open your mic.